I'm just curious, how do I know if I have to calculate percent?
Oh, it doesn't say percent.
Yeah, that's why I didn't do
the
the
point. Okay. Is that the reason you didn't do it?
Yeah.
So
you asked me how much, so I calculate the value, and I'm like.
But is it always the case that enterprise value differences and equity value differences are the same?
But it's the same firm, right? It depends on the fees, right? Because you have to compare the equity value first.
I'll give you the point. Just send me an email.
Yes, I got full mark for the first time.
Okay, send me the email.
Okay, folks. Your quizzes are up there ready to be picked up, so pick them up as soon as you can. Only 4 classes left, right? The whole semester? Today, Monday, Wednesday, following Monday. Which means that your final project is due less than 2 weeks from today. Right? Because we're in the end of April, so it's May 8th by 5 p.m. that day. So if you've been putting off doing the pricing for your company, this is the week to catch up. Next week you'll have exams to study for, so if you haven't met as a group, So I'll send some stuff on the project tomorrow, to-do list, basically, that you can go, to do, basically get it done, right? Your early final is May 11th, and I haven't checked the Google shared spreadsheet yet. Are you up to 60? Did anybody check? Okay. So if you want to take the final on the 11th instead of 15th, just go in and sign up there, and I'll work on it. Right? So let's pick up where we left off on Monday. I know you weren't even listening after the quiz. There's a problem, you're completely zoned out. But we were talking about real options. We were talking about the option to delay, and we used it to value patents and natural resource options. We talked about the option to expand, which is essentially you take a bad project because it gives you the rights to a big market. And we closed off with the option to abandon. And each of these options gets used out there even by people who don't really talk about options in a different context. I often hear about companies being valued more because they have more flexibility. You know what that basically means? That they seem to adjust much more quickly to what's happening around them. The option to abandon captures the value of preserving flexibility as a company. Okay? I'll give you a very simple example. Let's suppose you do a discounted cash flow valuation of Goldman Sachs. You come up with the value for the company. Traditional discounted cash flow value. Now, one of the legends that one of the stories at least that drives the Goldman legend is that Goldman seems to get out of mistakes sooner than everybody else. Then in 2008, they seem to get out about 3 months before or 4 months before the other investment banks. So if they make a mistake, they get out sooner than everybody else. And if they do something right, they're able to find a way to build on it much better than everybody else. That's part of the Goldman legend, and part of the reason they've usually traded at a premium over other investment banks. You see how this connects on to the option to abandon? Basically, if you can get out sooner than everybody else, that's like getting out of your mistakes quicker, which effectively means there's a much lower, the floor on your value is much higher than the floor on your value if somebody stays in there for longer. Well, part of the reason they might be getting this advance notice is the Secretary of the Treasury seems to always be a Goldman guy. Maybe they get a call. It's a conspiratorial view of why Goldman gets out ahead of everybody else. But that's what the option to abandon is. Think of it as a value flexibility. So I'm going to build on that theme now on the next option. How many of you are in my corporate finance class? Okay. And remember you did the optimal debt ratio for your company? Just nod even if you don't remember. You did do an optimal debt ratio for your company. And at the end of the class, we actually did a survey. How many of you found your companies to be under-levered, correctly levered, and over-levered? I went back and looked at that graph today because I wanted to just get a sense of what you found. And I think in that corporate finance class, 81% of the companies came out as under-levered. You know what that basically means, right? There's a debt ratio at which your cost of capital is minimized. Let's say it's 40%. But most companies seem to stop at 15, 20, 25% rather than go to 40%. I want to argue that maybe there's a good reason why companies don't go all the way to their optimal. And I'm going to use an option pricing argument to justify it. Usually when you think about options in capital structure, it's what you find in bonds, right? Convertible bonds have options, callable bonds have options. I have zero interest in those kinds of options because you can get that in a fixed income class. I want to talk about the value of financial flexibility. So here's what it is. You have an optimal debt ratio where your cost of capital will be minimized. You choose to stop at a lower debt ratio, even though you know your cost of capital is going to be higher. Why? Because you want to preserve financial flexibility. I'll tell you when I ran into these two words first, is when I first started doing optimal debt ratios. And I'd go to a company and say, your optimal is 40%. And they would have no debt. They said, we don't want to borrow money. And you push them, they would say, we want to keep financial flexibility. It used to drive me crazy. What exactly does that mean, keep financial flexibility? And I started digging. There seemed to be two reasons why they wanted to hold on to excess debt capacity. One was in case they hit a really bad bump in the road, that this would let them get over it, that they could borrow the money to get over that problem. The other was, and this was a bigger reason, is that investment of a lifetime showed up next year. That amazing investment, that having excess debt capacity would allow them to borrow the money and take that great investment. That really seemed to be driving why they wanted to hold back on borrowing money. So let's think about why this is an option. I'm going to argue that as a company, there are certain places you go to raise capital. Bank borrowing, maybe a few equity issues. Let's assume that there's a certain amount of reinvestment needs you can cover with regular financing. That becomes equivalent of the strike price. So let's say 6% of your value willing to raise as capital each year, that becomes a strike price. If the projects that come around that year happen to be less than that, you cover all of them, no problem. But let's say that your investment needs actually exceed what you can raise from that regular capacity, that's 6%. Having excess debt capacity will allow you now to draw on that debt capacity, borrow the money, and take that once-in-a-lifetime project. And the payoff you're going to get is not that you took the project, but from the excess returns you get from that project. So basically what you get by using financial flexibility is you get to take those projects you otherwise would not have been able to take. Like what kind of project? An acquisition of Twitter. A terrible acquisition, but no. A big acquisition that you otherwise couldn't have afforded, you can now borrow the money. Why? Because you held back on debt capacity. So I'm going to actually try to value this financial flexibility as an option. I'll explain why. What's the cost of being under-levered? What happens? Remember, this is what the schedule looked like, which is at different debt ratios. This is actually the 1997 schedule for Disney, where I have the debt ratio in the first column, the cost of equity in the second, the cost of debt after tax in the third, and the cost of capital in the last column. What's the objective in corporate finance? You want to minimize your cost of capital because that maximizes value. The optimal debt ratio for Disney in 1997 was 40%. See why? The cost of capital is 11.64%. They actually had a debt ratio of 18%. Their cost of capital is 12.22%. So by being under-levered, what's the cost they're bearing? Their cost of capital is 12.22% instead of the 11.64%. On an annual basis, they're paying 58 basis points or 0.58% because they chose not to be optimally levered. And their excuse is, we get financial flexibility for doing so, that's why we're not doing it. If I can value financial flexibility on an annual basis and come up with a number and say it's 0.5% or 0.3% or 0.9%, you see how that's going to help you? Because by being under-levered, you've given up 0.58% a year. And if financial flexibility is worth only 0.3%, you shouldn't be doing it. You should just go to your optimal. If it's worth 1.5%, then I think you're on the right track. You should be going out and holding back on debt capacity for that great project. So I'm going to try to value financial flexibility at Disney to see if the number I get is greater than 0.58%. So here's what I did. To value this as an option, I need the inputs, the option pricing model. And here's how I'm going to get the inputs. For the S in the model, the underlying asset price, I'm going to look at the reinvestment needs you have as a company as a percentage of value. By now, remember the reinvestment rate you had in the second quiz, or the third quiz, you have a sense of what reinvestment needs are, net capex and change in working capital. But here I'm going to compute it as a percent of firm value to see how much that is on an annual basis. To see how uncertain I am about those reinvestment needs, I'm going to look at changes across time. In other words, do I always spend 5% of value, in which case I might not need an option, but does it go from 3 to 15 to -2? So you could have lots of jumpiness in that number. That's going to be captured in the variance. The strike price is going to become whatever you think you can raise through your normal access to capital. You're saying, what the heck does that mean? Companies go out to banks, they have letters of credit, they have a certain amount of capital they can raise, and they get money from internal operations. That becomes the strike price for this option. And I'm going to value this option for a 1-year period. Why? Because I want to compare it to that 58 basis points I got as your cost of being under-levered. So I plug the numbers in, and here's what the option looked like for me. So in the case of Disney, the number was 5.3% for the reinvestment needs. That's what it was average over the last 5 years. The variance in the number was 0.375. There's a lot of variance because they did an acquisition of ABC in one of those years. The average internal reinvestment and the internal funding was 4.8%, and T is equal to 1. I valued the option, and the value that I got for the option with just those inputs was 1.6092%. That's actually a fairly meaningless number because that gives me the value of option to take a project. But let's revisit corporate finance. What's the value of taking a project? It could be 0, it could be positive, it could be negative, and we captured with a net present value. If you have a 0 net present value, the fact that you have an option to take a project means absolutely nothing. So to get this option to a number that I can use, I took the 1.6092%, and then I said, how much value does Disney create on a typical project? And here I had to make an assumption. In 1997, Disney was earning about 18.69% as its return on capital. Its cost of capital was 12.22%. It was earning about 6.47% more than its cost of capital. And if I make an assumption, and this is all it is, an assumption, that they can make that on their new projects, that 1.6092% option value becomes a value for financial flexibility of 0.85%. You're saying, what does that even mean? What is Disney doing right now? They're being under-levered. By being under-levered, their cost of capital is 0.58% higher than it should be, right? And by being under-levered, what are they saying they're going to hope to do? To be able to take these projects that might come along, and if I trust my numbers, the value of the financial flexibility that they're getting by being under-levered is 0.85%. So what's your end suggestion going to be for Disney? Don't borrow the money, be under-levered, because what you're gaining by being under-levered exceeds the cost. And you can already see the seeds for why some companies will never go to their optimal debt ratios. In fact, take a look at that equation, and I'll draw on 3 variables that are going to determine how much you value financial flexibility, and by extension, how close you should get to your optimal. Here's the first one. That K that I gave you, the strike price, reflected what you can raise in capital markets in a typical year. In conventional corporate finance, traditional corporate finance, we assume that the access to capital is free and unlimited. If access to capital is free and unlimited, what does K become? K becomes infinity, and if K is infinity, the value of the option goes to 0. So if you're a large company with as much capital as you can raise, why the heck are you holding back on debt capacity for the great project that comes along? Because you can take it anyway by raising capital. But if you flip that on its head, you can already see what kinds of companies are going to value financial flexibility the most. Private companies are going to value it more than public companies. Why? Public companies want to raise capital. What can they do? They can go to the stock market, they can go to the bond market, they can go to the bank. You're a privately owned business. You want to raise capital. What do? Well, you can try venture capitalists, but they extract their pound of flesh. You can tap your own savings, but you have only so much. And you can go to the bank, and maybe they will lend you money, maybe they won't. So a private company should value financial flexibility more than a public company. And by extension then, you should expect to see private companies borrow less than public companies. Emerging market companies should value financial flexibility more than developed market companies. Why is that? Fernando? Let's put the emerging market company in Venezuela. You want to raise capital. Where the heck are you going to go? If I constrain your access to capital, you will have to be entirely internally funded. you're going to value financial flexibility more than a company in Germany or the United States. So that's the first factor. Tell me how constrained you are. Second, tell me how predictable or unpredictable your reinvestment needs are. You're a regulated utility. You know you have to build 10 plants over the next 20 years. You know exactly how much you have to reinvest. You don't need to hold financial flexibility to do it because you just raise the capital that you need because you know what's coming. But if you're a social media company, a technology company, a smartphone company, you have no idea how the world is going to evolve, your reinvestment needs are going to be much more volatile. You should value financial flexibility more than a company that has predictable reinvestment needs. And here's the third and final factor. What's the value of this option again? It depends on how much you make over and above your cost of capital, right? If GM comes to you and says, look, we don't want to borrow money because if we borrow money, we will lose financial flexibility. Play devil's advocate. What's the question you're going to ask them? Financial flexibility to take bad projects? I don't want these guys to have financial flexibility. If you're a company in a business that has only bad projects, why would I want you to maintain financial flexibility? So if you're in a business which earns big positive excess returns, you should value financial flexibility more than a company in a business with bad excess returns. So it gives you an entirely different perspective on why companies might choose not to borrow. You know that technology companies are among the most underlevered in this market. Here's a simple example. Can Apple borrow a lot more money? Yeah, they have 80 billion in debt. They could probably sustain 500 billion in debt. Can Google borrow more money? Absolutely. I was at Google headquarters last week. That place is like a playground. They have enough cash to do whatever they want. Can Facebook borrow more money? Absolutely. Why are they choosing not to borrow money? Take a look at that list and you're already going to see the seeds for why a technology company, even if it has the debt capacity, will choose not to borrow money. It's because future reinvestment needs are incredibly unpredictable, and the last thing they want to do is to go out there and lock in the debt today and not be able to do those things in the future. Any questions on the value of financial flexibility? So let's move to the last of the options I want to talk about. And this is a fairly perverse example of real options. Let's imagine you buy equity in a publicly traded company, which is what you get when you buy shares in a publicly traded company. There are two ways I'm going to characterize what you've just done. First, you bought a residual claim. What does that even mean, a residual claim? Why is equity called a residual claim? Anna, why is equity called a residual claim? They're the last ones. They get whatever's left over, right? The bondholder gets paid a fixed interest rate, labor gets paid its wages, and if there's any cash left over, and there's no guarantee, you get whatever's left over. And if the company is liquidated, what happens? The cash first gets used to pay off the debt, and you're the last person in line. If there's anything left over, you get to claim. So that's the first feature of equity. The second feature of equity in publicly traded companies is you have limited liability. Kind, what does that mean, limited liability? Well, you have a liability, but only to the extent, Sam, what you've invested. This is actually good. My value in stock can go only to zero. It's it, that's it. I can't get a broker calling me and say your stock went to -5, -7, -11, -15, even though I might owe a lot more. Limited liability basically means that if I liquidate the company and I cannot pay the lenders, they can't come after my personal assets. Is that always true? If you own a private business, that might not be true. I'm a bank, I'm lending money to as the owner of a private business. I'm going to attach your house to it and the rest of your savings. But with a publicly traded company, you have a residual claim and limited. You're saying, so what? I'm going to argue that those two features will start to make equity look like an option if you get into enough trouble. Sounds like a strange characterization, but let me give you an example. You're the equity investor in a company. You know how much you owe, right? Let's call that face value of the debt as what you have to pay off if you liquidate the company. If you liquidate the company, if the value of what you get exceeds the face value of the debt, you get to keep the difference. You're the residual claimant. But if the value of the assets is less than the face value of the debt, the most you can lose is what you paid for the stock. So it's a limited loss. Sounds abstract, right? So let me give you an example with real numbers. Let's assume that, in fact, I want you to play roles. You guys are going to be equity investors. You guys are going to be lenders. They got the fund role, I'm sorry. So you're going to be lenders. You've invested in a firm. This firm right now is a value of $100 million. The lenders have lent money on one 10-year zero coupon bond. In a minute, I'm going to ask you why I've structured it this way. But you know what a 10-year zero coupon bond means? That basically for the next 9 years and 364 days, what do I owe you? Absolutely nothing. And at the last day of the 10th year, I'm going to pay you an $80 million face value. The 10-year bond rate is 10%. And that $100 million value that I've estimated for the firm today could change. How much could it change? The standard deviation in that value is 40%. So let's face it here. You're the equity investors, they're the lenders. You have a $100 million value firm today, but that could change. You owe one debt issue, a 10-year zero coupon bond for $80 million. I'm going to argue that with this very limited information I've given you, you should be able to tell me how much the equity in this firm is worth and how much the debt, what interest rate the lenders should charge. I haven't given you a rating, no cash flows, no beta, no cost of capital. But with this information, you should be able to answer that. And here's how you're going to do it. Think of your equity as an option, right? What's your option on? It's on the firm which is worth $100 million. It's your option to liquidate the firm. And if you liquidate the firm, what do you have to do? You have to pay those guys $80 million. You get to keep the difference. You have 10 years to play this game. Now do you see why I made this a nice zero coupon bond? If this were a regular bond with coupons every 6 months the power shifts to them, right? Because they demand an interest payment. If you're not able to pay, they can take the firm away from you. Here you get complete power over this firm for the next 10 years. So you have an option with a life of 10 years. The variance in that $100 million value is 0.16. The riskless rate is 10%. S, K, R, T, sigma, basically the 5 inputs I need for an option pricing model. I plug them in. I get D1 and D2, N of D1 and N of D2. And this is all abstractions. But what did we say N of D2 was? Last session we actually characterized this as measuring something. What does N of D2 measure? Fernando, what is it? The probability that this option will be in the money or exercising it, right? What does that mean in this context? What am I saying? There's a 63% chance that S will be greater than K. What's S here? The value of your assets. What's K? The face value of your debt. There's a 63% chance that the value of your assets will exceed the face value of the debt, which means there's a 37% chance of what happening? What happens when the value of your assets is less than the face value of your debt? You're bankrupt. There's a 37% chance of bankruptcy. There's actually an outfit in San Francisco called KMV. And their business is if you're a bank and you have a loan portfolio, you can go to KMV and you can give them your loan portfolio, and they magically will estimate a probability of default on that portfolio. And they charge a hefty fee for it. You say, how do they do it? They run an option pricing model. They get an N of D2. 1 minus that number will be your probability of default, just like we did, a 37% chance of default. And if I feed those numbers in, the value that I get for the call option, which is your equity, is 75.94 million. So there, that's your value for your equity, 75.94. Value of the business is 100 million. You subtract out the 75.94. The value of your debt is 24.06 million. It's a zero coupon bond, 80 million due in 10 years. If I tell you the value today is 24.06 million, you should be able to tell me what interest rate you would charge on that debt, and that interest rate would be 12.77%. You're valuing equity as an option, and you're dividing up the value of the firm between the value of the equity and the value of the debt. Yeah.
So that would also assume the equity investors get no payouts over the lifetime.
Exactly. And if there were payouts, you know what it'll look like? It'll be like a dividend. It'll actually reduce your value of the firm. You'd put it in as a cost of delay, a dividend yield, and that'll lower the value of your equity. So if they actually got payouts, the equity will get to be worth less, but you will get cash in your pocket every year for the next 10 years. So as an equity investor, you might actually welcome that. You'll get a lower value for the equity because the firm will become less valuable over time, but the drop in value is coming from me paying cash flows to you. Yeah.
Is there a disconnect between this kind of valuation of debt and reality?
If you lend money, never look at growth. That's one of the first rules in lending, is never lend on growth. Lend on cash flows. You know why? Equity investors enjoy growth. You don't. So in fact, when you're lending money, lending on growth is a very dangerous game to play. Lend on cash flows. That's why you look at things like interest coverage ratios. Ratings don't even look at growth rates, if you think about what goes into a bond rating. So as a lender, you really don't benefit from growth. In fact, I'm going to argue that the more ambitious your equity investors get, the worse off you're going to get as a lender. Because what they go for in ambition will actually cost you. And we're going to play that out when we start changing the inputs to this model. Right? So value of your equity is 75.94 million. And I want you to hold on to it, at least get the basic intuition, because now I'm going to ask some what-if questions about these valuations. So let's say you trust me, you go out and buy equity and you lend money to the firm at a 12.77% rate. Let's say you wake up tomorrow to some catastrophic news. Half the company has disappeared. Don't ask me how this happened. They have 2 factories. One in California, one in Florida. Take your pick. Hurricane or earthquake, one is gone. And you didn't insure it. Your company value has gone from 100 million to 50 million. Let's start with the easy question first. Equity investors, is this good news or bad news for you? Unless you have a very perverse definition of good news, you open the paper, half the company is gone, your equity is going to drop in value. Lenders, is this good news or bad news for you? Don't take too long. You've lent money to a firm that you thought was worth 100 million, half the firm has disappeared, bad news for you as well. Let's see how bad the news is. Let's work out the effect on value. What was your value before this happened? Do you remember? 75.94 million. Your value was 24.06 million. Let's see what's going to happen to the value of the equity, and let me give you some choices. The first is to take the 75.94 million I estimated yesterday, or just before this happened, and knock it down by 50 million. Why 50 million? Because that's what I've lost in value. That'll make the value go from 75 to 25.94 million. The second is that your value is, that your equity is worth nothing. In fact, if you talk to your accountants, that's what they're going to tell you. Your book value of equity could have turned negative. The third is that your equity will drop, but it'll drop by less than 50 million. So those are the 3 choices. Will it drop by 50 million, more than 50 million, less than 50 million? What do you think? Less than 50 million, right answer. But if it's less than 50 million, then what are you also telling me? Somebody's got to bear this loss, right? So if you lose less than 50 million, who's the only other player in this room who can be sucked into the game? Now I call on the fact that you're my partner. You don't want to be partners. Come on, partner, share some of the pain. So the 50 million is going to get divvied up with some of the value dropping from your equity value and some coming from the debt. Let's see by how much. Here's what I did. I went back into the option pricing model. Remember, the only thing that's changed is the S, right? It went from 100 to 50 million. I computed D1, D2, N of D1, N of D2. Let me pause there again. What was the probability of default before this happened? It was 37%. Remember, it's 1 minus ND2. 37% chance. Now that this has happened, what's the chance of default now? It's almost 60%. No surprise, half the company disappears, much greater chance of default. Your $75.94 million in value has now become 30.44. So you've lost $45.5 million of your value. And guess what? You didn't want to be drawn into this game, but you've lost $4.5 million of your value because you're now lending to a much riskier firm. Once I started doing this, I couldn't stop myself. Let me explain what I mean by that. I dropped the value from 100 to 50. The value of equity dropped, the value of debt dropped. So I kept dropping the value of the firm to 40, to 30, to 20, to 10, to 5, to 3, to 2, to 1. You know what I wanted to find out? When does equity become worthless? I mean, you still owe the 80 million, right? If I drop the value of the firm to 3 million and you owe 80 million, you'd think your equity would cease to have any value. I could not make equity's value go away. It is an incredibly stubborn instrument. It hangs in there. I drop the value of the firm to 1 million, equity that's kind of by its fingernails, still have value. So let me ask you a question. What's keeping the equity afloat here? In fact, you can see that in the graph. As I lower the value from 100 to 10, you can see the equity drop, but it doesn't drop to 0. What?
The probability that variance will bring it back up.
It's hope and time. You see, you need both. Hope what? That the variance will bring the value up, but for that to happen, you need time, and you got 10 years to play. It gives you an entirely different perspective on what it means to actually be bankrupt. My daughter, who's now 21, taught me this lesson when she was 3. She's a financial genius. Not really, but on this one she turned out to be very prescient. So she was about 3. It was the summer of Monopoly. I used to play Monopoly with my sons, and she had 2 older brothers. And she'd insist on joining in. Very persistent, so finally I would let her join in. And after about 3 games of Monopoly, I had to banish her. Because she was like a one-person Enron. She would collect 200 for not passing go. She'd put hotels and properties that didn't belong to her. She'd charge you for things that didn't, And after the 3rd game, I said, Kendra, you're banished. Tiny person, horrible temper. She starts walking around and saying, you're bankrupt, you're bankrupt, you're bankrupt. And I'm very impressed that a 3-year-old is using the word bankrupt. So I said, Kendra, what does bankrupt mean? Expecting an answer like the value of your assets is less than the value of your outstanding liabilities. She said, bankrupt means you don't get to play the game anymore. And you know what? It's a perfect definition of bankruptcy, because what's keeping the equity afloat here? It's that you get to play the game. As long as you're playing the game, you're not bankrupt. That's why equity has value. So when you see shares in basket case companies continuing to trade, you say, who buys shares in these companies? Are these crazy people? There might be some crazy people in the mix, but they don't have to be crazy. You're buying an option. Most of the time, if you're buying a deep out of the money option, most of the time when you buy deep out of the money options, what happens to them? They end up worthless, you toss them in the trash can. But when they do pay off, you make 5,000% returns. In the early 1990s, Continental, at that time, before it got acquired by United, was almost bankrupt. It was technically bankrupt. Every accountant looked at it and said, it's done. You could have bought its shares at $1 per share. 2 years later, the stock was trading at $53 per share. Imagine buying a stock at $1 per share, seeing it rise to 53. That's what you get with these deep out of the money options. And to get there, you have to recognize when your stock stops being a traditional stock. What does that mean? The traditional stock, you want cash flows and growth and low risk. But with an option, you don't care about cash flows. Who cares about growth? And you want low risk or high risk? You're deep underwater. You want as much risk as you can. You're playing a very different game, and that's what you have to recognize. It's something that I have to ponder with my Valiant investment. There is a point in time with every company where you get to this point where it starts to behave like an option. Valiant's not quite there, but it's getting really close. And the 2 things that usually characterize you have a lot of debt. You need that in this game. And you're in lots of trouble. Valiant meets both those requirements. You essentially have an option. Any questions on viewing equity as options? So deeply distressed companies. You know what I mean by distress, right? It's losing money and has a lot of debt. There is this possibility that your equity could have value as an option. Now let's use the same vehicle to talk about why what's good for stockholders. And Sam brought up this issue of lenders versus equity investors. Let's see how this game can sometimes put you into conflict. So I'm going to ask you a couple of questions that are going to sound like slam dunk easy questions. Humor me and give me the slam dunk easy answer. Let's assume that you go back to this original firm. So let's say pre-earthquake, pre-hurricane, you go back to the $100 million firm. Remember the value of the equity was 75.94, the debt was 24, the value of the firm is 100. Let's assume that I come to you, I'm a project salesperson. I sell you projects. I come to you with a project for sale. I say, hey, I have a project for you. You're very well versed in corporate finance, so you ask me, what's the net present value of this project? I say, minus $2 million. What's your first reaction after your corporate finance class? You're going to toss me out. Say, why would you want to buy a project? I said, no, wait. Not only is the net present value minus $2 million, it's a really risky project. This is making it really, it's going from bad to worse, right? I'm going to argue that if you're the equity investors in this company, you might actually gain by taking this project. One of the most perverse actions in corporate finance. You're taking a negative net present value risky project and you're walking away a winner. Saying, how the heck can that happen? Let's take it layer by layer. If you take this project with a negative net present value of minus 2 million, your value as a firm will go from 100 million. Net present values are additive, right? So you take 100 million, take a project with minus $2 million net present value, your value as a firm will drop from 100 to 98. You're saying, there, I told you so, don't do it. But that's not the only change. Your value of the firm will drop to 98. You still owe the 80 million in debt. You still have 10 years to play the game, but now your standard deviation has gone from 40 to 50%. And I compute the value of your equity. And here's where the magic happens. Remember what it was before I took this bad risky project? It was 75.94. After I take this bad risky project, your value of equity just went up to 77.71 million. Sounds incredibly perverse, right? But what's happening here? I am stealing enough money from my bondholders, and I don't want to sugarcoat it to make it look like you're doing anything else, that it's overwhelming that negative net present value. Because equity is an option, you can start to see this happen. So what's a lesson you take out of this? If you're a banker lending to me, and I'm a private equity investor doing leverage buyouts, you're Bank of America, JP Morgan. I come to you to borrow money from you. You lend me money to do a leveraged buyout. Should you let me run the firm? After all, I'm Blackstone, I'm KKR, I'm full of smart people in there. Should you let the equity investors run the company if it's a heavily levered transaction? If you let the equity investors run the company, what are they going to do? They're going to keep taking riskier and this is called risk shifting. Basically what you do is you take the risk, you collect the upside, you pass the risk on to the lenders. It's a great game for equity investors to pay, which also means if you're Bank of America or JP Morgan, lending on a leveraged transaction, you need to become part of the management of the company. You need people on the board, you need people in the management, because you cannot let equity investors do what they want, because what they do in their best interest might not be in your best interest. Any questions on? Let's do one other example. We're going to soon talk about acquisitions and how they can destroy or add value. But let's take a very simple example of an acquisition. Let's assume we go back to being a $100 million firm, $75.94 million equity, $24.06 million debt. You're planning to do an acquisition of a firm that's worth $150 million, and you're doing this right. You pay fair value. You pay exactly $150 million for that firm. So you're buying a firm worth $150, you're paying $150. That's like taking a project with a net present value of 0, right? So what will happen to your equity after you do this? Again, give me the slam dunk answer. It should do nothing, right? You've taken a fair value project. Let's see how this plays out if you think about it. Equity as options. Let's assume there's your firm, Firm A. You're taking over Firm B. Each firm brings debt into the game. Firm A brings in 80 million, Firm B brings in 50 million. Each brings in its own standard deviation. Firm A has 40% standard deviation, Firm B has 50% standard deviation. But remember, these are two firms in different businesses. In fact, the correlation between the two businesses is only 0.4. You're saying, so what? I don't know whether you remember that when you took your first finance class, did you talk about the portfolio of a two-asset portfolio? You do this as the start to portfolio theory. You remember? Weight 1 squared times the variance of the first asset plus weight 2 squared times the variance of the second asset. And then there's this third complicated term which captures how the two assets move together. It's a covariance term. It's the building block for all of portfolio theory. That's basically what you have here. You have two companies that are now going to become one company. The variance of the combined company is going to be the weight of the first company squared. 40% of the first company is 40% of the value, 100 divided by 250, times the variance of the first company, plus weight of the second company squared times the variance of the second company, plus this covariance term. Don't let the equation intimidate you. Here's the bottom line though. The variance of the first firm was 40%. The variance of the second firm was 50%. The variance of the combined firm is 0.15. It's less than the variances of the two firms. It sounds like magic, right? But this is the basis for diversification. Essentially what you've done is created two companies in different businesses, and by bringing them together, you've created a safer company. You're an equity investor in the company. What was your value coming from? The variance in the underlying assets, right? Now you created a safer company. In the combined company, the value of equity, even if you pay fair value and you don't borrow additional money, the value of the company will drop because your equity has now become less valuable. You now have a safer company. Your lenders will benefit. And here's why they're benefiting. They lent money to these individual companies based on their individual risks. So they set interest rates based on that. Now you've created a safer company, and I still have the same interest rate. I'm getting paid too much. And that's pushing up my value by about $3 million. Yeah.
So, does looking at firms like this, does the option pricing model apply if these firms were giving out? Because I know it's not included if they were giving out large dividends.
All it is a cash. So basically, remember the dividend-adjusted version of the Black-Scholes? Yeah. It'll still work. In fact, it'll make the problem we're talking about for lenders even worse. Do you see why? Because who sets the dividends in these companies? The equity investors through the board of directors. So whatever conflicts you have, I can even make it worse, because while you're sitting there holding on to your debt, I can undercut you by paying out these big dividends every year and making the value of the firm go down without any bad stuff happening. So in fact, when you have dividends, that actually adds a second layer to this process, whereas equity investors, I get an option, plus I get cash flows every year that I set. And it makes it much worse for you, which is one reason why if you look at lending to leveraged companies, one of the things that will come with almost all of the lending is dividend restrictions. Because if I don't put the dividend restrictions, I'm really completely exposed as the lender to the company. So I can use the option pricing model, but then I'm also going to have a second layer in which I'm going to have this wealth transfer through the dividends.
But companies that are bought by equity investors for being extremely stable.
That's different, right? Because for this, remember I said there's a tipping point? If you're buying Microsoft, there is no optionality there. It's the option to liquidate that drives the value of the equity option. So if you have companies with 10% debt, 15% debt, 20% debt, nice, stable, solid companies making money, there's no optionality. So I'm not worried about wealth transfer, because there's no wealth transfer happening. It's as the debt ratio climbs and your operating performance deteriorates that I start worrying about this. Because now you're starting to run your company as an option person would, not as somebody who wants to collect traditional cash flows and value the company as a going concern. Right?
So valuing a lot of the equity based off variance only really applies for these companies that it's kind of a shot in the dark whether or not they'll make it, not necessarily for like.
Or when you're, who's valuing J.C. Penney? So, or somebody who's valuing J.C. Penney, or many of these retail companies. There are people. So if you take that subset of people who are valuing money-losing companies, where you're worried about will the company make it, and they have debt, so all three pieces have to come in, right? You have to be money-losing, you have to worry about the company not making it, and you have to have debt. It's not going to work with Snap. It's money-losing. You might worry about it not making it, but what does it not have? It doesn't have debt. Without the debt, there's no strike price, the optionality disappears. So you need all three pieces. So it's more likely that you will see this in declining businesses. A lot of retail companies right now, you're really getting options. As valued as going concerns, you're saying, I'd be crazy to buy J.C. Penney. But valued as an option, especially if you think about liquidating the real estate and collecting the difference, you're playing a different game. And that game might be what's driving the value of the equity in these companies. So it's actually, what I'm giving you is hope. If you had valued that company, so if you were valuing one of those companies in your DCF, there were about 10 of you who turned in DCFs where you concluded that the equity value was negative. Basically, the value of the operating asset was less than the debt. You concluded, I'd be crazy to buy the stock. So on the DCF basis, you're putting a zero value. On a pricing basis, you were just as desperate, right? Because nothing worked. There was no price earnings, no price to book. There's this little window of opportunity I'm going to give you where I say maybe it's an option. And maybe you might still buy the stock, but it has to meet all of those requirements. Any other questions? So now let's think about trying this on a real company. Because the example I gave you is incredibly abstract, right? I gave you the value of the firm as 100 million. I gave you the variance in that value. I told you you had one nice zero coupon bond outstanding. What troubled company has one nice zero coupon bond outstanding? You've lent money from every person, you borrowed money from the guy at the corner of the street. You're that desperate. You have 50 different bond issues. Saying, can this really work for a real company? I think it can if you're willing not to be a purist. If you're willing to be pragmatic. So here's the way I'm going to try to get these inputs for a JCPenney. For the value of the firm, I'm going to do a traditional discounted cash flow valuation. So the DCF you did of the operating assets is still going to work. In fact, I'm going to put no growth is valued as a DCF. I'm going to come up with a discounted cash flow value for the assets. That's going to become the S in the model. In fact, if you're really lazy and you want to just add up the values of the 5 properties that the company owns and say this is the value, I'm okay with that as well. So that becomes the starting point, the value of the underlying asset. For the variance in that value, I'm going to get a little desperate. If it's a publicly traded company, I can look at stock prices and bond prices and try to compute a variance in firm value. But if you have a troubled company, let's face it, your stock is doing weird stuff, your bonds are doing weird stuff, coming up with a weighted average of weird stuff plus weird stuff is weird stuff. So I'm going to cheat. Let's say you have a troubled retail company like JCPenney. Rather than try to get the variance in firm value by looking at that company, I'm going to look at the variance in firm values of publicly traded retail. Remember how we did betas? I had a beta average. I actually on my website have variances in firm value and equity value by sector. So you have a troubled steel company, a troubled airline, I can tell you what the typical variance is. I can use that variance. And if I want to get really fancy, I don't know whether you remember those Monte Carlo simulations we did. I did with this Royal Dutch. I got values across the simulations. I can compute a variance across those values. I can use any of those variances as my variance for the model. I'm being creative, I'm probably stretching the definition, but I have to get a number to get started. For the value of the debt, here's what I'm going to do. I'm going to take all of the debt you have outstanding, the 50 different debt issues. I'm going to add up the face values of all of the debt. And I'm even going to add the coupons you have to pay in year 1, year 2, and come up with a cumulative amount that you owe on your debt. And I'm going to treat it like the face value of a zero coupon bond. I told you I was not going to be a purist. And then finally, I'm going to take a weighted average of the duration of all the debt you have. You know the duration of a bond is it gives you the equivalent zero coupon bond, right? A 10-year bond, if you tell me the duration is 7.2 years, that's the duration of an equivalent zero coupon bond. I'm going to take all of your debt and compute a weighted duration, and that is going to become the duration of the debt that I use in this model. So let's try this. You've heard of Eurotunnel? That hole in the ground where cash goes in but never seems to come out. Built with a whole lot of ambition between England and France. And when it was first built, people thought, oh, it's going to make a huge amount of money. It's never made money. It will never make money. Maybe I shouldn't be that radical, but it's never made money so far. So this was actually a valuation I did of Eurotunnel equity in 1997. So let me first make the case as to why I think this equity looks like an option. First, in 1997, Eurotunnel was losing money. It was losing a ton of money. In fact, it was losing 56 million in operating losses and 685 million in net losses. So it's losing a lot of money. First condition met. Second, its book value of equity was negative. What does that tell you? How does your book equity become negative? You keep losing money for extended periods. So not only did they lose money last year, but they've been doing it for a long enough time period that their equity is zero and went further. So it's a money-losing company. Check. Second, I checked to see how much they owe. They owed 8.9 billion pounds to everybody who would lend them money. Short-term debt, 10-year debt, 20-year debt, really long-term debt, collectively 8.9 billion pounds. And the weighted duration of the debt was almost 11 years. So not only do they owe a lot of money, but it's really long-term debt. They're a money-losing company with a lot of long-term debt. We nailed this coffin shut. I did a discounted cash flow valuation, assuming fairly healthy improvements in margins. The company would go back to being a going concern. And the value that I got for the company with a discounted cash flow model was 2.3 billion pounds. How much debt they owe again? 8.9 billion. My DCF value for the assets is 2.3 billion. This is a deep, deep, deep out of the money option. So it's a money losing company with a lot of debt, but the value of the assets has dropped way below the debt. We've got every condition met for applying an option pricing model. The final input I need before I use an option pricing model is how much variance is there in the value. And here I actually did use the stock price and the bond price for Eurotunnel. They both trade in the London exchanges. Debt was about 85% of value. Equity was 15. The standard deviation equity value was about 41%. The standard deviation bond price was about 17%. Remember, when you look in the firm, it's both equity and debt put together. It's a two-asset portfolio equation again. The variance that I got in Eurotunnel value was 0.0335. I have everything I need. I have an S, I have a K, I have a T, I have the variance. So remember, we all agree this is a basket case company, right? Would you buy shares in the company? You're saying, are you crazy? Why would I buy shares in the company? The value is 2.3 billion and the debt is 8.9 billion. And if this had been your company in the project and your DCF value, you'd have said it's worth nothing. In the pricing, you'd have said nobody's going to buy this stock, but let's try this as an option. 2.3 billion pounds becomes the S in the model. That's the value of the discounted cash flow value for the assets. For the strike price, I use the face value of all of the debt outstanding, 8.9 billion pounds. For the life of the option, I use the weighted duration of my debt, almost 11 years. The variance in value is 0.0335 and the riskless rate is 6%. I do D1, D2, N of D1, N of D2. Anna, what's the probability that Eurotunnel will not make it?
It's like almost 100%.
It's 92.5% chance. No surprise here, 92.5% of the time I won't make it. But here's the magic. This is a basket case company, but the equity is worth 122 million. If you're buying that equity though, do it for the right reasons. As opposed to the wrong reasons. Don't buy this equity because you expect to get dividends. You're not going to get dividends. Don't buy it for the cash flows unless you like large negative cash flows. Why are you buying it? For the same reasons you buy deep out of the money options. You sit, you pray, and you hope. You sit and pray and hope some more. And most of the time your prayers will be for naught, your hope will turn to dust, your equity will go to zero. But maybe the Sultan of Brunei will one day say, I'd like my name on the tunnel, here's $12 billion. Hey, hope springs eternal. You buy deep out of the money options, and you can see why then stocks can continue to trade even when there's significant trouble. Yes, Ari.
If Black-Scholes prices it like on a risk-neutralized basis.
No, wait, don't back up. Black-Scholes doesn't price it on a risk-neutral basis. What allows us to do the risk-free rate? Remember the two building blocks for all option pricing models? One was replication, and the other was arbitrage. The reason we use the risk-free rate is not because we assume risk neutrality, but because the way we price options, we create a riskless position. A lot of people have a misunderstanding that somehow Black-Scholes just breaks the rules of risk aversion. We don't use risk-free rates because of risk neutrality. We use risk-free rates because the basis for option pricing is you're going to buy the call option and sell the replicating portfolio. And because they have the same cash flows, you have no risk. And because you have no risk, you use the risk-free rate. Okay. So it's not that we assume it on a risk-neutral basis. It's because the basis for pricing is if I see the underlying asset there and there is an option, I can create a riskless position. And if I can create a riskless position, when I do the option pricing, the risk-free rate is what I should be using.
But so then couldn't you only do this if this firm actively has options to trade it?
No, you don't need the firm to have options. You need to be able to buy the shares of the stock and you need to buy the equity. And in this case, I can do both, right? So this is one of those cases, and this is actually what you might have heard of convertible arbitrage that some hedge funds do. This is exactly what they do. They take a company with both stocks, bonds, and perhaps convertibles that are traded, and they play the securities off against each other, and they try to create essentially a riskless position where they don't really care what the value of the company is. They're just playing the mispricing across the securities. We're actually just playing off the mispricing of securities when we do this. Right? In fact, I want people to be clear. I've heard people who trade options claim that Black-Scholes is based on risk neutrality. It's not. It's based on replication arbitrage. And that's why this option is more defensible than the one on the patent, right? Because there the critique would be, you can't trade the patent, you can't trade the product. This is a misuse of option pricing, I concede. But this one, I think, is actually a much more defensible case because both the stocks and the bonds are traded. You should be able to create the replicating portfolio. Any other questions? So let's close the real option section, right? Before I do that though, let's assume you decide to become a vulture investor. You know what vulture investors do? They invest in troubled, distressed companies. And you decide to put this to use. I'm going to give you some choices about where you should invest your money. And you tell me, based on what we've just talked about, where your investments will go. So you're looking for troubled companies, money-losing companies. Do you want to invest in money-losing companies with a lot of debt or very little debt? A lot of debt, because you need the debt for that. Do you want the debt to be long-term or short-term? You want it to be as long-term as you can. And do you want these companies to be in risky businesses or safe businesses? You want super. Go to Capital IQ and do a screen, right? Basically look for companies with very high debt ratios, because you need that. Capital IQ, I might not have the maturity of the debt, but if they had a weighted average maturity of the debt, you'd want the longest maturity you can. And you want to get the highest variance in value. So if you can find that trifecta, lots of debt, money-losing companies with a high variance in that value, you essentially found options. It doesn't mean you're guaranteed to make money, but it's a very different way of thinking about investing is to invest in those companies. So if you ask me to summarize everything we've talked about, real options are options everywhere. So if you look hard enough, you're going to find options in pretty much every aspect of what you do. Okay? Most of those options you can ignore because they don't have significant economic value. Why? Because there is no exclusivity. So when people talk about the option to expand to the Chinese market, you're going to say, that's nice, but where's your exclusivity? If you have exclusivity, sometimes you can use option pricing models, and you're far more solid ground if you use them where you can trade the option and trade the underlying asset. But the real value to me from options is not that you use Black-Scholes and apply an option pricing model, is that you recognize when you're actually investing in an option as opposed to stock. And that's why I used Valiant as an example. There is a tipping point that's coming, and it's coming pretty close because Valiant right now is $9.02. Hit that tipping point, Valiant is no longer going to behave like a conventional stock. It's not going to be driven by dividends and earnings and cash flows. It's going to be driven by the variables that drive options. I have to adjust the way I think about Valiant when that happens. Every year on my portfolio, I buy one option-like stock. You know what I mean by that, right? Troubled company, lots of debt, and I'm making a different play on that stock than on any other stock in my portfolio. I'm going to measure it with different dimensions, pick it differently than every other stock. Because you need balance in your portfolio. You need something like, you can't have all of your portfolio be options, but maybe 5-10% of your portfolio. No harm putting into options because these will be the investments you boast about. At that cocktail party you're at, I made 50 times my money. You want to be able to boast about things, buy some options and hope and pray one of them pays off. Because all you need is one good story. Don't mention the other 35 times you tried this and lost money. Just let that be between you and your brokerage house. But this could be your one story, the story that gets people gathered and really you made 35 times your money? Hey, that's exactly what will happen when you succeed. Any questions about anything to do with options? Okay, so I'm going to get started on acquisitions. And this title has actually gotten me into some trouble sometimes. But it's actually a title I picked because a good friend of mine runs these executive seminars in New York City, and he keeps calling me for topic after topic, and I said, no, you know. So this was actually an executive seminar he was running maybe 10 years ago. And he collected CFOs of serial acquirers. You know what serial acquirers are? These are companies like a Book of the Month club. They do an acquisition of the month every month. So companies that do lots of acquisitions. So he'd got this seminar where only CFOs of acquiring companies, of these serial acquirers had shown up. And he calls me and he says, would you be willing to come in and talk to these people? I said, are you sure? You know what I think about acquisitions, right? I don't think much of them, and you want me? He said, yeah, I want you to come in and talk, because for the rest of the day, they're going to be hearing from investment bankers. What do investment bankers think about acquisitions? It's a mother's milk of deal making, right? This is it. This is it. So he said, I want to kind of be you to be the counter. I said, give me the last 30 minutes of your session, and I'll be there. So I showed up, and I put up my first slide, and they knew exactly where I was going to come from. Because to me, acquisitions are a disease. They're an addiction. Because once you start growing by acquiring companies, you don't want to go take projects anymore. It's so much work. You can double the size of your company like 5 minutes. You get all this glory, egos, bankers patting you on the back, telling you how great you are. So I call this Acquirers Anonymous 7 Steps to Sobriety. So I'm going to set up the case for why I think acquisitions are such a bad deal for stockholders and acquirers. So let's play the acquisition game. Okay? In acquisitions, there's the acquiring company and the target company. So I'm going to make you guys, since you had the fun of being the equity investors in the last deal, I'm going to make you acquiring company stockholders. I'm going to make you target company stockholders. Before I show you any graphs, without even telling you the name of the deal, which group would you rather be in? Stockholders in acquiring companies or stockholders in target companies? So let's start with that graph. So the red line is those guys. The blue line is you. Basically, what is this line? It looks at what happens to your stock price around the day of an acquisition. So day 0 is the day of the acquisition. This starts 20 days before, goes through 20 days after. So on the day of the acquisition, the stock price of the target company jumps by about 16%. The acquiring company gets a little blip, and then it keeps going down. This is actually an interesting... What did I say day 0 was? That's the date that the news actually hits the market, right? Notice something that seems to happen on the red line before day 0. It starts like day 7, day 6, day 5. This shows you how incredibly smart markets are, because they can predict what's going to happen that they don't even know. Or, if you're a little cynical, what's the other possible explanation for why prices start to go up before the news actually gets out? Somebody's leaking. Let's face it. You can pass all the laws you want to pass about insider trading, but this graph kind of gives away the fact that there are still people who find a way to trade ahead. That's never going to go away. So I'm not going to sit here and say, give you the moral lecture. This is horrible. This is terrible. If there's a lot of money at play, it's going to happen. But if you're going to be on one side, it clearly seems to be that acquiring companies' shareholders, if not the losers, tend to come out like 50-50. Target company shareholders are the winners. In fact, collectively, there is evidence that acquiring company stockholders lose about 1 to 2% of their value, while target company stockholders gain about 20% of their value. You think that's okay, still the app. But acquiring companies tend to be much bigger than target companies. 2% of a $500 billion company might be greater than 20% of a $10 billion company. So this is what happens the acquisition date. So I start with this graph. 50 hands go up. There are about 50 people in the room. So this is unfair. You're looking at the date of the acquisition, and these investors don't see what we see. You see what the argument they're making is, these are uninformed investors. We see the stuff. We see the synergy. We see the control. We've seen the projections. What happens in the acquisition day is not a good indication. I said, you're right. Maybe you should track these acquisitions 5 years later and see how well they do. So here's my second piece of evidence as to why acquisitions are so crappy for stockholders. Forget about what happens on the acquisition day. You can blame strange markets, irrational markets, short-term markets. If you track acquisitions 5, 6, 7 years after the process, here's what you find. McKinsey actually looks at acquisitions and asks 2 very basic questions. And you tell me whether either of these questions is unfair. The first question it asks is, did the return on capital on these acquisitions exceed the cost of capital? That's such an unfair question, right? But isn't that the question we ask of any investment? So ask that question. Second, many of these acquisitions, the acquiring company claims it does it because it makes it better than the peer group. So the second question I ask is that true? Do acquisitions help acquiring companies outperform the rest of the sector? And the answer is no on one or both questions on most acquisitions. This is nothing to do with the acquisition date. This is actually tracking these acquisitions 5 years later. KPMG, in the late 90s, actually collected information on almost 6,000 M&A deals. And that's a singular question. What's the one word you hear thrown almost in every acquisition? Synergy, right? So the question asked was, in what percentage of mergers, if you track them 5 or 10 years later, do you actually see synergy? You say, how would you see synergy? The argument for synergy is two companies coming together do better as a combined company than they would have as individual companies. So that's all KPMG looked at, was did the combined companies do better than the individual companies? In 80%, in the actual number was 83% of cases, there was either no synergy or reverse synergy. What does that mean, reverse synergy? Two companies come together, and the combined company actually does worse than the two companies that come together. In 1 in 6 mergers, does synergy show up? Clearly, there's something wrong with this process. In fact, there's another study that looked at acquisitions 10 years after and found that almost 1 in 5 acquisitions was reversed within 10 years. This is the ultimate admission it didn't work. So if you look at the evidence on acquisitions, there's almost no contesting it. Collectively, acquisitions don't seem to create value, and they're not good news for acquiring company stockholders. But I have some worse news. Almost all of these studies were studies done on US companies because that's where the data was, until the last 10 or 15 years. And in fact, most emerging market companies were targets of acquisitions rather than acquirers until about 15 years ago. So if you're an Indian company or a Chinese company, 25 years ago, you didn't acquire a developed market company. Developed market companies acquired you. But the balance of power has started to shift, right? And it's a source of great nationalistic pride in these countries now that Indian companies can now be the acquirers rather than the target companies. Chinese companies can now be the acquirers rather than the target. Brazilian companies can now go. This is a mixed blessing. Because remember what we said about it's better to be a target company. It looks like the disease is spreading. What disease? This disease of overpaying on acquisitions does not seem to be restricted just to US companies. Emerging market companies seem to repeat the same mistakes. Sam?
In order to know whether or not the acquisition is bad, you should be in control.
That's what they do. They control for the rest of the sector. If their margin drop because the sector saw a drop in margins, they account for it. So when these studies look at whether you did well or badly, they take into account the fact that if you're a pharmaceutical company and pharmaceutical companies saw margins drop by 3%, your margins will drop even if you did the right thing. The question is, did they drop by more than 3% or less than 3%?
And what if you're a company that's also, you're not necessarily looking for growth in acquisition, but you're taking out a competitor?
Defensive acquisitions, right? This is the most dangerous reason for an acquisition, right? Because you're doing it because if you don't do it, somebody else will do it to you. To which my response is, if you're in such a bad business, the only way you can survive is by doing bad investments. This is a corporate finance class. What do you advise them to do? Shrink, get out of the business. Surviving for the sake of surviving gives you nothing. So the only way you can survive as an airline is by overpaying for target companies because you want to stay in business. It's a terrible way to survive. So companies do it all the time. We'll come back and examine these defensive acquisitions. But if that's what you're doing, that's already a symptom you're in a bad business. Yeah.
But to use an example, so if Facebook acquired a company like WhatsApp, not because they thought that it would increase their revenues, but they thought if WhatsApp grew,
that would have been a terrible reason to do it, right? They did it for the right reasons, which is they wanted to bring WhatsApp into the Facebook ecosystem and get you, when you sent a message, to be in the Facebook ecosystem. That's why it's worked for them. So if, in fact, Facebook had bought WhatsApp to preempt somebody else from buying WhatsApp, this deal would not have played out the way it did. So the way Facebook has behaved with WhatsApp since it acquired it clearly tells me that they weren't worried about somebody else acquiring WhatsApp. They were acquiring WhatsApp for a very different reason. Facebook Messenger stinks. WhatsApp is much better. And they said, look, if we can bring it in and make it part of our ecosystem, and it's working. I wouldn't be surprised if soon, the same reason you bought Instagram. They didn't buy it because somebody else would have bought it. They bought it because they knew they were short on the video or the visual part of the social media. So I think Facebook has acquired companies for the right reasons. Lots of companies acquire them for the wrong reasons. And with both those companies, what's the other advantage Facebook had? They were private companies. You think, so what? With private companies, how do you decide how much to pay? It's a negotiated number. With public companies, how do you decide what to pay? You take market price plus. So when we talk about what kinds of acquisitions succeed, we'll see some of the things that's allowed Facebook to be successful with its acquisitions.
And then the last thing I want to ask is, where do you draw the line between like strategic buyers who are getting hurt and then sponsors who would claim that they're buying acquisitions where they're going to a holdings company actually do really well?
Strategic. What is the other word I use for strategic buyers? Stupid buyers, right? So if you're selling a business, find a strategic buyer. Because a strategic buyer basically says, I want to buy, I'll think of a good reason later. Okay? You're saying, wasn't Facebook? I don't think of Facebook as a strategic. All good buyers are financial buyers, which means to me that eventually you find a way to generate earnings and cash flows. So I think that we've had this very lazy way of categorizing buyers into strategic buyers, which means you don't have to do your number crunching, because they want to buy the company first and worry about the numbers afterwards, or financial buyers want to worry about the numbers first and then do the acquisition. I think the line to me is a much grayer one. You can be a buyer who's buying for very different reasons than a financial buyer is, but that doesn't make you a strategic buyer. You're just buying for different financial reasons. Yeah.
But that's kind of what I was asking,
Yeah.
because a lot of the people that are like quote-unquote strategic or doing acquisitions are actually conglomerates that are similar to holdings companies.
And they don't do well, right? That's in fact the place where acquisitions go to die. Is that subset of buyers is in fact the worst, have the worst records in acquisitions. There's a conglomerate discount for a reason. Is these companies get created, and not only they overpay, there's a discount now applied to your overall value because I worry about you continuing this insanity of buying companies and bring them into the fold. So in fact, we're now going through a period of reverse consolidation. Right? Where consolidated companies are starting to break up because we've recognized how much damage was created in the process of creating these companies. So as we look at the evidence, we'll see what works and what doesn't, and maybe there's room for somebody with a different set of perspectives to do acquisitions and still walk away with value. Okay? But the bottom line here is, and this is what I want to end today's session with, is this process is clearly broken. It's broken beyond debate. Acquisitions just don't work. And we've known it for 35 years, maybe 40 years. But here's the insanity. The game doesn't end. It keeps going and going and going. And it's not because the people involved in the process are stupid people. These are among the brightest people in financial services and M&A. So you have smart people involved. Everybody kind of knows it's not working. So the question is, how come it continues without improvement? And my answer is there's something screwed up about this process, and we know what it is. So lead me through how an M&A process works. You're an acquiring company, you're a target company. Let's say it's a friendly merger. What happens first? Before you even meet, you hire a banker, right? So now you got 4 people in the room. Acquiring company managers, target company managers, acquiring company's investment bank, target company's investment bank. There are only 4 of you in the room. Who in this room doesn't want this deal to go through? Do the bankers not want this deal to go through? Of course not. They want the deal to go through because that's how they get paid. So the 2 bankers are saying, yeah, this is a great deal. The target company managers, oh, this is a great deal. And even the acquiring company managers say, it's not my money anyway, who cares? It's a great deal. There's nobody in that room who's putting a brake on this process. And that's the reason why I describe M&A as the place where valuation first principles go to die. Because you're going to bend every conceivable rule because the deal becomes the name of the game. You can dress this up as much as you want, but you need to get the deal done by hook or by crook, and crook is going to be more likely than hook. And by the end of this process, when you show me a DCF for an acquisition, it's pointless because you've already decided the deal is too important to let fall apart. So what I'm going to send you is actually a series of 7 questions for the next class. And these are fundamental things that I see going wrong in acquisitions. Think of it as a kind of self-test. And this is a test I offered those 50 CFOs of serial acquiring companies. I said, I'm going to give you a test, and if you fail more than 3 of the 7 questions, I want you to stop doing acquisitions. None of them took me up. Let's see if you pass the test, because I'm going to send, these are 7 very basic questions, and they're based on what we've already done in the class. So try to give it your best shot before you come to class next week, and we'll talk about the answers to those questions.
Firstly, you were mentioning that the reason we can use option pricing is because we can buy the debt. I was wondering, for certain investors that have mandates of not being allowed to own certain debt below certain grades, can they then not use the option pricing model for equity?
As long as there's somebody else who can use it, they can still get away with it, right? I mean, in a sense, you know, and you might sometimes even have only bank debt, non-traded debt, and still be able, the bigger issue is can you trade the stock and the underlying assets. You can do both.
Makes sense. Okay, lastly, one thing about this, I think I emailed you as well, just I saw on number 2 right here, you had put in the grading template that if you got return on capital wrong, then you lost a point, which I understand, but I was just wondering if I could work it out with the fact I got it wrong originally because I originally miscalculated invested capital.
I'll give you half points.
Yeah, came back and forgot to change it off.
Okay.
Thank you.
Notes?
Thank you.
Excel spreadsheet which had a collection of numbers and and then you put it into a PDF and you cut and paste in the Excel spreadsheet. So the question is, was there something that I was missing that was of more depth? I mean, explain to me how you went through the reasoning to how.
So we definitely misunderstood the project at the beginning. So that was for sure, it was for sure our fault. And then whenever we got it back and you replied to us, we felt that we were crunched with time. We thought you.
At that point, it was probably too late to go back and do the thinking. The question I was trying to extract from you is whether you've done the thinking then, because